Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Listeners looking to construct an investment portfolio that produces an income may want to consider looking towards Asian equities. Today's guest tells us more about the ripe dividend landscape in the region and discusses investment opportunities ranging from technology to insurance.
I'm Chris Sarley, and today we're joined by Jochen Breuer, manager of the elite-rated Fidelity Asian Dividend Fund. Thank you for joining us today, Jochen.
Hi, Chris. Thanks for having me.
Let's start with the fund itself. It aims to provide what's called as cross-cycle performance, which in a nutshell means it aims to do well no matter what's going on in the sort of wider Asian or indeed global economy. For the listeners, maybe just explain how you go about this and what sort of companies fit the sort of stereotypical mold for this.
Yeah, I think that's a great starting point. So when I took over stewardship of the fund around 6.5 years ago, really we set out to achieve three key outcomes for our clients. The first being, as you mentioned, outperformance of the index through the cycle. Secondly, to deliver an attractive headline dividend yield, which at the moment is around 4% on the fund, and dividend growth over time. And thirdly, to achieve this with lower risk characteristics than the market. And with that, I mean a relatively lower drawdown in falling markets. So the focus is really to deliver an attractive risk-adjusted total return, where the dividend is an important part of that total return over time. And the fund itself is fairly concentrated in nature, so around 30 to 50 names over time. And it's managed without any reference to the benchmark. And the average holding period, I would say, is 3 to 4 years of the companies we own. So it's very much a patient approach to investing. Now, as one would expect for a dividend strategy such as ours, the fund does exhibit certain style characteristics. So because of the type of companies we invest in and our focus on downside protection through the focus on valuation, the fund tends to behave more defensively. So it tends to outperform in falling markets, but it lags in strongly rising markets. And for example, 2020 was such a difficult year for us, as sectors such as the Chinese internet companies strongly outperformed, and those tend to pay limited dividends and therefore are not really featured much in our investable universe. But we managed to recover the performance and some more in 2021 and 2022. Now, our investment approach is very much bottom-up focused, and we have more than 50 analysts here on the ground in Asia, which are constantly meeting and analyzing companies. And with their help and through stock picking, we can hopefully deliver against those three outcomes that I mentioned at the outset. And I'm glad to say that we have delivered against those over the last 6.5 years. You also asked me, obviously, what type of companies more specifically we're looking for. And a number of characteristics I would highlight. The first being that the companies we invest in tend to have strong business modes and therefore can generate attractive and resilient through cycle returns. They tend to have conservatively managed balance sheets and good cash generation. And we're looking for good governance frameworks. And on top of that, management teams that have shown good capital allocation in their businesses, where the dividend is an important part of that capital allocation framework. And management that manage these companies in a sustainable manner. The final point I would make is on valuation. So it's not quality at any price, but we're very valuation conscious. So the focus is really on protecting the downside to achieve attractive risk-adjusted returns for our fund holders.
Okay. I'm going to touch on a couple of themes on the back of that. Firstly, technology. You mentioned that you think technology could enter a recovery phase in the second half of this year. Why do you think that is, and what impact have to your portfolio? And I asked that in the wider context of, you mentioned that defensive positioning. I think you've got about, just shy of 20% in technology, or you had about that sort of number. I mean, does tech sort of is tech a defensive investment now? Or how do you maybe just give us a view on that, please?
Yeah, no, absolutely. So as you mentioned, technology stocks are around 18% of the fund today, but we have been adding to those holdings over the last few months. And I would classify that part of the portfolio certainly more within the cyclical bucket within the portfolio. And if we kind of go back and think about what has happened, I guess listeners will be aware that the wider technology space benefited from increased customer demand during COVID, which while supply chains were impacted, and therefore we have seen those disruptions. But really over the last 12 months, some of those trends have reversed. So while supply chain issues have largely been resolved, I would say, demand, for example, for PCs, notebooks, and mobile phones has weakened. And hence we have seen kind of inventory levels of components and also of end products increase. But I think crucially, we believe that we're past the worst here and have, for example, started to see those inventory levels starting to come down. And hence we think from a cyclical backdrop, this is supportive. And at the same time, valuations for a lot of these hardware technology names, which are really leaders in their industry here in Asia, those names look attractive. And if I could maybe talk about one stock that we like, it would be Samsung Electronics. Many will probably know Samsung's consumer products such as TVs or fridges, but by far the biggest profit contributor is Samsung's memory division, in particular DRAM memory, which goes into notebooks, mobile phones, servers, and so on. So why do we like Samsung? I guess the first point would be from a structural perspective. So memory is an industry that has consolidated over time. And today there are really only 3 scale players left in the industry in the form of Samsung Electronics and SK Hynix in Korea. And then you have Micron in the US. And that makes for a much, much more rational market than it used to be the case. And I think we're seeing that playing out right now. So as a result of the weakness in demand that I talked about and the depressed profitability, these 3 industry players have now started to reduce capacity utilization and capacity expansions. And we think this is really the last step that is required for an ultimate kind of cyclical recovery in that industry. And Samsung, kind of coming back to your point about cyclical versus defensive, we think Samsung is in a very good position to weather the storm here, as it's really the lowest cost producer within the industry. And it also has a very strong balance sheet. In fact, almost a quarter of its market cap is currently sitting in cash. And for an income investor like myself, what's important really is that they have an absolute dividend policy. So despite the cyclical weakness, they're paying a stable dividend. And that obviously is very important for me as an investor. And lastly, and I think I mentioned it before, is really on valuations, which we think are very attractive and provide a very positive risk-reward profile for the stock.
Just quickly, does that mean a group like Samsung might almost be considered cyclical and defensive, if you see what I mean, because it's in such a strong position?
Yeah, absolutely. I think, cyclicality comes obviously from the underlying industry they operate in, which is a cyclical industry. But then when you look at the strengths of the company in terms of its balance sheet strengths, and for example, also the shareholder return profile, I think that makes it and lastly, also the valuation that the stock is trading on makes it very attractive from that perspective, and gives a very attractive risk-reward profile, which we see.
I'm going to turn to a sector which perhaps has not been seen as very attractive for the best part of 15 years. So, banks. Let's talk about a couple of Asian banks. Sure as have the banking issues that have sort of been reverberating in the US and Europe been felt in Asia? I assume you're confident they won't be contagion, as you've added, I think it's HSBC has just been added to portfolio. Maybe just give us a bit of an outlook on that and, what you would be watching for if you're not concerned.
Yes, absolutely. So again, financials are roughly 20% of the fund. But when looking at the exposure within that, one thing that I would highlight is that historically and also today, the majority of our holdings are non-bank financials. So these would be, for example, leasing companies, exchanges, or also selective insurers that we like. Why do we prefer those type of companies over banks? Really, the reason is that they tend to operate in attractive niches of the market, which have less competition, and therefore the potential to grow faster and generate very attractive returns on capital. An example of such a company would be, for example, Chili's in Taiwan, which provides leasing companies for SMEs, so small and medium-sized companies in Taiwan, in China, and also in Southeast Asia. And this is a market that's not really being served by the large banks, as the business model is too specialized and too labor-intensive for those larger banks to compete. And as a result, Chili's can generate attractive returns and grow at very decent rates. So when it then comes to the banks, and to your question, I would say the first thing I'd say is that those issues that we've seen in the regional banks in the US and also around Credit Suisse in Europe have really only limited read across for Asian banks, I would say. And the reason being that most banks in Asia have very strong capital positions. They are subject to strong regulations. Plus, they have a very large, stable deposit franchise in most cases. There are obviously other drawbacks, such as the fact that a large part of the bank's universe in Asia are state-owned enterprises, and hence not necessarily only managed for the benefit of minority shareholders. And this is why we are very selective when investing in banks in the region. The one bank you mentioned, obviously, that we have been adding over the last few months is HSBC. And there are a number of characteristics that we like here. The first being the restructuring of the business that management has done over the last few years, selling a number of underperforming non-core assets and geographies, which we believe will lead to stronger and improved return profiles of the group. And because of those restructurings, the other thing is that Asia now is more than 50% of the business, and it's obviously a higher growth kind of market. And lastly, I would say the capital position attracts us, which is very strong and allows management to return significant funds to shareholders through dividends and buybacks. In fact, they announced a $2 billion buyback today. And we believe 30% of the current market capitalization will come back to shareholders over the next 3 to 4 years.
Just on the landscape, obviously your focus is on individual companies, but you also have to take a look at the macro environment they operate in. It can't be ignored. So given that in mind, we've had a challenging couple of years with China and the ripples that they cause, and we discussion about how big those ripples are perhaps changes. Obviously, there's a lot of divergence between US and Chinese monetary policies, and I just wonder how that and China in general impacts the wider holdings. Could you maybe explain are the ripples as big as perhaps they may have been seen to be 15, 20 years ago? You know, just how much do you have to batten down the hatches every time China sort of really kicks off?
Yeah, maybe a little bit of kind of backdrop. I'd say probably listeners know that China has been in a very restrictive kind of zero COVID policy for almost 2 years, which only really ended at the end of last year. And since then, we've seen a rapid reopening of the economy supported really by monetary easing, but also by fiscal policies. And crucially, I think China is not seeing the inflationary pressures that we experience in the West, and that makes those policies really feasible in the first place. On top of that, we've seen much more supportive regulatory backdrop over the last few months. So we've seen policy support when it comes to, for example, the property sector, and clearly, I think we're seeing that the government is supporting the economy wherever it can. While the recovery really has not been all that smooth and partly behind initial expectations, I think the direction of travel for the Chinese economy and the intention of the government really has become clear. Now, compare that to the backdrop of Western economies, and I would include Australia, for example, here as well, where monetary policies are restrictive to fight inflation, and hence we are really seeing a slowing consumer and corporate environment. From a fund perspective, what I would say how it has impacted, since last year, we've really been looking for more companies that benefit from the reopening of China, not only in China, but also within the wider region, as China obviously remains by far the largest economic force in Asia. And an example would, for example, be regional companies that benefit from an increase in Chinese tourism. Because one of the trends we have clearly been seeing, I think, over the last few months, is that the Chinese consumer has strong pent-up demand for services, for example, tourism, while demand for goods, especially those larger ticket items, is still somewhat lagging behind.
Let's turn to dividends. Obviously, you're seeing dividend increases this year. What's your outlook for the rest of 2023 and beyond? Are you confident, pensive? Just give us a view on that as well, please.
Yes, sure. So I think one aspect that makes Asia an attractive hunting ground for income investors really is that it offers attractive headline yields, but it also has good prospects for dividend growth over time. And on the one hand side, for example, you have countries such as Australia or Taiwan, which are more mature in nature and also have certain tax advantages or tax incentives for companies to pay higher dividends. But on the other hand, you have some of those more emerging markets where payout ratios are still relatively low, and you should see higher dividend growth over time from the companies operating in those countries. So another aspect I think we have seen over time is that different governments have encouraged companies to return more cash to shareholders. And that is something we definitely are seeing at the moment with respect to the Chinese state-owned enterprises. When I look at the fund and the dividend announcements of the companies in the fund year to date, I would broadly say that they have been in line to slightly better than expected. And I think that reflects really kind of the improving fundamentals in Asia with the Chinese reopening, and which also results in higher confidence of management teams. And to give an example, Swire Pacific is a top 5 holding in the fund. And they have not only decided to initiate a sizable share buyback program a few months ago, but also increased their dividend by around 15%. And we believe there's ample room for more dividend growth going forward as the business recovers.
And Jochen, can we just finish with a couple of companies in a couple of areas of the market you might be excited about? Just, you're very company focused. Let's maybe just get a couple more beyond the ones you've talked about already that you're particularly excited about at the moment.
Yes, absolutely. So let me talk about maybe Singapore Exchange, which has been a holding for a number of years. And this falls into this bucket, which I talked about earlier, of non-bank financials. So exchanges, we think, are attractive businesses because they tend to have very strong business modes in the form of certain network effects, as clients tend to choose the highest liquidity pools and the lowest cost operators to execute their trades. And Singapore Exchange in particular has very dominant positions in a number of derivative and foreign exchange products within the region. Another reason we like it is that it's a business that generates high margins, is fairly capital light in nature, and therefore generates a significant amount of cash. And this allows management to grow the business at attractive rates and at the same time return cash back to shareholders in the form of dividends. Another maybe a little bit more underappreciated aspect, we think, is that the exchanges benefit from rising interest rates, as they can invest the float that they keep for their clients at higher rates in the current environment. And finally, from a portfolio perspective, I think what's also interesting is that the exchanges tend to benefit from increased market volatility. So it's also a very attractive stock to own from a portfolio diversification benefit perspective, as it makes an attractive defensive holding within the fund.
Jochen, once again, thank you very much for joining us today.
Thank you, Chris.
The Asian market is one of increasing relevance and importance for equity income investors, and this fund is well placed to capture that trend. The fund generates not just an above market yield, but also one that can grow, offering attractive total returns. To learn more about the Fidelity Asian Dividend Fund, visit fundcalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.